Hello, welcome to the channel. Don't forget to like and subscribe. Today we are going to talk about the effect of inflation on bank interest rates. The effect of inflation on bank interest rates has become a topic of discussion among entrepreneurs, banks, shareholders, and other related parties. When discussing macroeconomics, inflation is often associated with other economic elements, one of which is interest rates. Interest is the cost incurred as a result of the activity of borrowing money. Relation between inflation and interest rates. High and low interest rates can be influenced by various factors, not only the debtor's score or rating, but also influenced by supply and demand. When the demand for loans is high and the supply is low, the interest rates will be higher. However, in particular, each bank has the authority to determine the interest rate for each loan. The exact amount of interest cannot be more than the interest rate set by the central bank. The central bank is supported by policy instruments that can influence inflation rates and play a role in regulating price stability and economic growth. This is because the central bank is the holder of the highest authority when determining monetary policy. With this authority, the central bank can also manipulate interest rates in the short term. That is what affects inflation in the economy. In addition, inflation and interest rates have an inverse relationship when inflation increases, interest rates will decrease. When interest rates rise, the demand for loans will decrease because people prefer to save with a higher rate of return from savings. This will have an impact on the minimum amount of money spent. If allowed to continue, it will have an impact on the slowing down of the economy and the inflation rate will decrease. Before discussing the effect of inflation on bank interest rates, at least the relationship between inflation and bank interest rates can be described in three elements. These elements are the banking system, the role of interest rates, and the theory of the quantity of money. The following is an explanation of these three elements. Number 1. Banking system. The effect of inflation on bank interest rates can be related to elements of the banking system. The banking system is the rules, procedures, and patterns used by the banking sector when carrying out its business activities in accordance with the provisions of the law. Within the scope of current economic development, the banking system used is fractional reserve banking. The fractional reserve banking is a banking system that allows commercial banks to generate profits. One of these ways is to generate profits by lending out part of the customer's deposits or savings. The other part will be stored in cash profit in withdrawals. Number 2. The quantity theory of money. The second element related to the effect of inflation on bank interest rates is the quantity theory of money. The quantity theory of money in economic states that inflation is determined by the demand and supply of money. The more money in circulation, it can push up price so that each note decreases in value. On the other hand, if the amount of money in circulation decreases, the price of goods and services will decrease. With this condition, the price of goods and services have decreased and the inflation rate has decreased. Number 3. The role of interest rates. The last element related to the effect on inflation on bank interest rate is the role of interest rates. The interest rate acts as the price that must be paid when saving or borrowing money. For the part of the deposit that is obliged to pay interest is the bank to the customers. As for lending, Of course, the borrower or debtor is obliged to pay the interest rate on the loan to the bank. When interest rates are low, individuals, communities, and entrepreneurs will apply for many loans. This will have an effect on increasing the amount of money circulating among the public. The more the amount of money in circulation, the more it pushes up financial inflation. Now, how do you think? Hello, welcome to the channel. Don't forget to like and subscribe. Today we are going to talk about what is critical illness insurance and who should have it. No one can predict when or what disease will strike in the future. Even the risk of disease will still exist and can come at any time even though the person has adopted a healthy lifestyle. It's no secret that the cost of treating a disease is not cheap, even more when we are in the middle of ongoing inflation. With this increase in medical costs, maintaining health and preparing for the possibility of suffering from a critical illness in the future is a very important step. So, what are the most common examples of critical illness? Number 1. Stroke. A stroke occurs when there is a disruption in the blood supply to the brain. Number 2. Cancer. The second critical illness that causes the highest mortality is cancer. Cancer is actually another term for malignant tumors in several parts of the body, which can affect all people and all age groups. Number 3. Diabetes. Diabetes is a type of chronic metabolic disease caused by reduced effectiveness of insulin. If the patient is injured, it is also difficult to help, so frequently they have to undergo an amputation process that costs hundreds of thousands of dollars. Number 4. Heart disease. Heart diseases are quite diverse, ranging from disorders of blood vessels, rhythms, valves, and others. The cost of heart treatment also varies, but what is clear is that it is costly. Number 5. Other critical illness. Of course, there are still some critical illness besides the 4 diseases above that we must be aware of. Some other critical illness are kidney failure, acute nervous disorders, hepatitis, meningitis, AIDS. Just imagine, when someone is exposed to a critical illness, there will be some risks that will arise in the future. The two greatest risks of this disease are the inability to earn a living and death. What will happen if the breadwinner contracted this disease when he was still productive? Of course, the family will be burdened financially. Therefore, having critical illness insurance becomes a necessity to complete health insurance. Critical illness insurance will protect us from financial losses due to the cost of treating this disease. What are the criteria for good critical illness insurance? How do we choose insurance so that it is right for us? Let's get into it. Number 1. Broad protection coverage. A good critical illness insurance should have a very broad coverage. The more types of critical illness that are covered by protection, they show the more complete protection that can be provided by the insurance. Everyone has a different medical history. Therefore, the threat of critical illness that we experience cannot be equated. It is very important to recognize the types of critical illness that are included in the coverage of an insurance protection. Number 2. Benefits of death without a death benefit. Of course, a critical illness insurance can be said to be incomplete. This benefit will be very useful for the preferred family so that they can continue to live properly. When a family head is not covered by this insurance and dies due to a critical illness, it is very likely that the emergency fund will be used to pay for medical expense during illness, to sell assets to pay for this cost. After that, the family left behind will lose income to assets, until finally their standard of living drops. What if the family in question still has debts? Their financially burden will certainly feel very heavy. Number 3. Easy claim process. A good insurance claim process, of course, must be easy and not long-winded. When the claim documents are complete, then within a certain period of time, the sum insured will reach in the insured's family. These are the tips to choose a critical illness insurance. Hope it can help you guys.